sir. Our topic for today is all about the monetary policy. Me and Christine Joy Capistrano are discuss about the relationship between the money supply and monetary policy. We discuss also the types, the tools, and the goals or objectives of monetary policies. We discuss also the function of foreign exchange market and participant in foreign exchange market.
So let's tackle first about the money supply and monetary policy and the relationships of the two. So the first one is the money. Money, anything that is generally accepted in payment for goods and services or in the repayment of debts. Money supply refers to all BSB notes and coins in circulation, thus the quantity of money. Monetary policy refers to the measures or actions taken by the Bangko Sentral ng Pilipinas to help keep inflation low and stable. The relationship of these three are: the money is what we need in production and money in circulation, or the money supply. If the money supply of the country is higher than the production of goods and services of the economy, there is a result of inflation, but the monetary policy will take actions to manage inflation so that the economy will grow brighter. Types of monetary policy. The first one is the expansionary monetary policy. This is a monetary policy setting that intends to increase the level of liquidity or money supply in the economy and which could also result in a relatively higher inflation path for the economy. The second one is the contradictionary monetary policy. This is a monetary policy that intends to decrease the level of liquidity or money supply in the economy and which could also result in a relatively lower inflation path for the economy. The tools of monetary policy, and we have three of them. The first one is the open market operations. This refers to the buying and selling of government securities by the Bangko Sentral for the purpose of credit control. It affects the quantity of reserves and the monetary base. The second one is the discount policy. This is a tool taken by the central bank to control the money circulation by raising or lowering interest rates. The third one and the last is the legal bank reserves requirements. This refers to the percentage of bank deposits and deposit substitute liabilities that banks must set aside in deposits with the BSP which they cannot lend out, or were available through reserve-eligible government securities.
There are 6 goals or objectives in monetary policies. First is the price stability. Second is the high employment. Third is the economic growth. Fourth is the stability of financial market. Fifth is the interest rate stability. And last is the stability in foreign exchange market. The Bangko Sentral ng Pilipinas, through its monetary tools like open market operations, interest rates, legal reserve requirement, and moral suasion, can stabilize price fluctuations, especially inflation. What is price stability? Price stability is desirable because of the rising price level or inflation creates uncertainty in the economy, and that uncertainty might hamper economic growth. The second goal or objective of monetary policies is the high employment. The Bangko Sentral can channel its resources, together with other financial institutions, toward the generation of jobs. Labor-intensive industries should be given top priority beneficiaries of liberal or soft loans from the financial system. This way, more people would be employed in just a short time period. More jobs result to more incomes, and more income lead to more purchases of goods and services. The third one is the economic growth. This is the result of economic development. Clearly, funds are needed for economic development. The construction of roads, bridge, communication facilities, irrigation systems, and the setting up of factories and other industries require hog capital. The financial institutions, through the leadership of the Bangko Sentral, can supply the funds of economic growth. Next is the stability of financial market. In economics, the concept of a market does not necessarily refer to a fixed place or location like divisoria market or central market. There is a market whenever buyer and sellers agree to exchange, regardless of their location and how they transact their mutual interests. The second to the last is interest rate stability. What is interest rate? This is the cost of borrowing money or the amount paid for lending money expressed as a percentage of the principal. A central bank, after all, cannot consistently pursue and achieve multiple goals with only one policy instrument. Faced with rapidly rising price, a central bank would have to reduce money supply or raise interest rates to maintain internal stability. While such policy action can increase unemployment and fuel financial market volatility in the short run, the trade-off between price stability and other potential monetary policy goals also diminishes over time. And last but not the least is the stability of foreign exchange market. What is foreign exchange market? Foreign exchange market is a place where the trading of currencies and bank deposits denominated in particular currencies take place. This is an institutional and communications networks like any other financial market. When residents of one country trade with residents of another country, they must generally convert funds between the currencies of the two countries to facilitate payment. Currency conversion requires a rate to define the value of one currency in terms of another currency. This is the exchange rate.
There are four functions of foreign exchange market. The first one is the facilitation of trading in currencies. The next one is the determination of exchange rates between currencies by the interaction of demand and supply forces. The third one is the facilitation of interaction fund transfers. And the last one is the facilitation of trading functions for hedging currency risks.
Participant in the foreign exchange market. Foreign exchange dealers are those who are engaged in the buying and selling of foreign exchange and who makes profit out of the difference between the buying and selling of foreign exchange. It includes institutions as well as individuals. Foreign exchange supplies are those earning foreign exchange and who sell their money at the foreign exchange market in terms of domestic currency and sometimes in other foreign currencies. Hence, creates supply of foreign exchange in the market. This includes the OFWs or the overseas Filipino workers and the foreign exchange users. These are those who are in need of foreign exchange such as importers, Filipino tourists, and students studying abroad.